Hello everyone. In this video, I'm going to cover chapter 12 of the Managerial Accounting course that has to do with differential analysis, which is a key to decision making. Basically, in this chapter, we will always have two or more options to choose between. So differential, when we say differential, there's a difference between two options, whether the difference is a cost, a revenue, and so on. So in the first learning objective, we are going to identify relevant and irrelevant costs and benefits in a decision. So we have relevant cost, relevant benefit, irrelevant cost, and irrelevant benefit. In the first key concept that has to do with the relevant and irrelevant costs and benefits, every decision involves choosing among at least two alternatives is called a differential analysis. Therefore, the first step in the decision-making process is to define the alternatives being considered. For example, the alternative of going to college is going to work, or maybe staying at home and saving the money. So there are always alternatives. Irrelevant cost and relevant benefits should be considered when making a decision. Irrelevant costs and irrelevant benefits from the name should be ignored when making a decision. So the key point here is to identify whether a cost or benefit is relevant or irrelevant to your decision. The key to effective decision making is differential analysis, or analyzing the difference between two alternatives when it comes to costs and benefits, focusing on future costs and benefits that differ between alternatives. So differential cost, differential revenue or benefit, it's the same. Incremental cost is an increase in cost between two alternatives. So this is an incremental is basically or simply is the additional, anything additional. Okay, the same meaning. An avoidable cost is a cost that can be eliminated by choosing one of the two alternatives. For example, if you choose to withdraw, let's say, the TV division in your company, the salary of the marketing manager of TVs is an avoidable cost. So you avoid paying the salary of the marketing manager of the TV division if you close this division. Sunk cost is any cost that has become irrelevant. Usually it happens in the past, or it's something that you cannot revive anymore. For example, the depreciation cost of the machinery is a sunk cost. The insurance policy of the car is a sunk cost, something that occurred in the past that cannot be revived. So for example, if you want to take into account selling your car, the insurance policy cost that you paid at the beginning of the year is irrelevant anymore. It doesn't make sense to consider the cost of this insurance policy in the decision whether you sell your car at a specific price, and therefore the insurance policy cost is now a sunk cost. Future costs and benefits that do not differ between alternatives are irrelevant to the decision-making process. So in some cases, you have future costs and benefits between options A and B that are the same in the future. So this is irrelevant. It doesn't make sense to include them in the analysis whether to go with option A or option B. Most of those things that I've been discussing so far are common sense. But we should have some definition for each and every concept. But those are common sense. You will realize when you get into problem solving that most of them are logical. They don't even need accounting. The last concept is the opportunity cost, which is something that you are foregoing to take another option. So the opportunity cost to go with option B is the benefit of option A. The opportunity cost of going to college is the money that you could have deposited in the bank, and so on. Now, identifying relevant costs An example. The example is telling us about Cynthia, a Boston student who's considering visiting her friend in New York. So she wants to go from Boston to New York. She can drive or take the train. So here we have two options, either take the train or drive using her car. By car, it is 230 miles from Boston to New York. She's trying to decide which alternative is less expensive. Alternatives are option A, driving, option B, taking the train. And she has gathered the following information. The annual straight line depreciation on the car is given on annual term and cost per mile. Cost of gasoline, $0.1 per mile. Annual cost of the insurance and license is also given per mile, per year, of course. Maintenance and repairs, 0.065 per mile. Parking fees at school per mile. And total average cost also per mile. Remember that some of them are based on annual basis, but we are dividing them by the number of miles based on 10,000 miles driven per year. So on average, Cynthia drives 10,000 miles per year. So we are dividing the numbers by 10,000 to get it per mile. So 360 divided by 10,000 is $0.036 on average per mile, and so on and so forth. Now, some of these costs are relevant to the decision and some of them are irrelevant. Just a quick example, cost of gasoline is something that I should take into consideration because there's a $0.1 per each mile you drive from Boston to New York. However, the annual cost of the auto insurance and licensing, this number has been incurred as an expense, insurance expense, and it cannot be revived anymore. So it's a sunk cost. It's irrelevant to the decision anymore. So this is the same given as the last slide. Some additional information. They are telling us that the reduction in the resale value of the car per mile of wear, so after driving each mile, the value of the car decreases by $0.026 per mile. Round trip train fare, $104. So this is our alternative. This is the alternative. So in order to decide whether to take the train or the car, we need to compare the $104, which is the train ticket price, to the estimated cost of using the car. Benefits of relaxing on a train trip, this is something good, relaxing instead of driving. However, you cannot quantify it in dollar terms. Cost of putting dog in kennel while gone, $40. This is an example where this number applies whether you take the train or you take the car. So this is something that doesn't differ between both alternatives, and therefore it's irrelevant. It shouldn't be considered in whether when deciding on whether to take the train or drive. Benefit of having a car in New York, it's something good, but however, you cannot quantify it money-wise. Hassle of parking a car in New York, it's something bad, but again, you cannot quantify it. Per day cost of parking a car in New York is $25, and this is irrelevant cost. So to recap, the relevant costs that should be taken into account when deciding on whether to go by train or use your car is the cost of the gasoline, of course, cost of maintenance and repairs, which is a reduction in the resale value of the car per each mile of wear. So the decline in the resale value, round trip train ticket, which is the alternative, and the cost of parking in New York. So all of those are relevant. Some factors are relevant, however, you cannot quantify them, such as the benefit of relaxing on the train and the negative effect of the hassle of finding a parking in New York. The irrelevant costs are cost of the car, it's irrelevant. The annual cost of the insurance, because you paid it already. The monthly parking fee at school, it's irrelevant. It doesn't matter whether you take the train or you take the car. You have paid for or you will pay for the monthly parking fee regardless. The kennel cost, because either way, you will use the kennel to put your dog or your pet, and therefore it's irrelevant between options A and B. So the relevant financial costs of driving is the gasoline, which is $0.1 multiplied by 460 miles. This number is the 230 one-way. So going back, you will multiply it by 2. So $46 is the cost of the gasoline. Maintenance, 0.065 per mile. So estimated maintenance and repair, $29.9. Reduction in resale value is relevant, of course, and it's estimated to be 11.96. And finally, parking 2 days in New York is a $50 thing. So the total is $137.86, which should be compared to the alternative of $104, which is the train ticket. So obviously, this is the right decision to make, to take the train. So again, all of those are common sense. We just have a few concepts or a few terms that we need to understand, like a relevant and irrelevant cost or benefit, a sunk cost, opportunity cost, differential analysis. So this is a differential analysis, basically. We have two alternatives, and the difference between them is determines whether to take option A or option B. Another example that has to do with differential analysis, total and differential cost approaches. The management of a company, the example says, the management of a company is considering a new labor-saving machine that rents for $3,000 per year. So you will rent a machine that costs $3,000 per year, and accordingly, you can save some of the wages you are paying to your employees. Data about the company's annual sales and costs with and without the new machine are. So the current situation without the machine and the situation with the machine. The sales are the same, direct material, direct labor, also it's the same, so it's irrelevant to the decision. Direct labor, without the machine, we were paying $40,000. With the machine, we're paying $25,000. So we're saving $15,000 difference when having the machine. The variable overhead is the same. Other expenses are the same. Fixed expenses, you are paying $3,000 for the machine, so it's a fixed expense. Without the machine, it's a zero, of course. And that's it. So basically, if you think about it, you can prepare two complete income statements without a machine and with a machine. But a more a smarter approach is to prepare a differential cost and benefit analysis or differential analysis, where you are saving $15,000 in wages and you're paying an additional $3,000, which is the cost of renting the machine. Therefore, you are saving in total $12,000, and this will be the increase in your net operating income from $18,000 to $13,000. So this is a quick example about the differential analysis. So this is what I just said. In total, you are saving $15,000 and you are paying $3,000 to save those $15,000. So collectively, you are saving $12,000, which is the addition to your net operating income. The second learning objective, we are preparing an analysis showing whether a product line or business segment should be added or dropped. The example says, due to the declining popularity of digital watches, Lovell Company's digital watch line has not reported a profit for several years. So this company, Lovell Company, is a company that sells watches, and they have the line of digital watches. And for quite a few years, this line hasn't reported any profit. So the line is making losses. Lovell is considering whether to keep this product line or drop it. The decision rule whether to drop this line or leave it should be as follows. Lovell should drop the digital watch segment only if its profit, the company's profit, would increase after dropping this line. Lovell will compare the contribution margin that would be lost if the digital watch line was discontinued to the fixed expenses that would be avoided if the line was discontinued. So the digital watches line, the benefit of it is the contribution margin, and the cost of it is the fixed expenses. That can be avoided, of course. So the income statement shows of the digital watches a total sale of 500,000, variable expenses a total of 200,000. Therefore, the contribution margin is $300,000. So if you think about it, dropping this line will make you lose those $300,000. On the other hand, you might be saving some of the fixed expenses, of those fixed expenses. General factory overhead 60,000. So we need to see if this general factory overhead can be avoided when dropping the line. Salary of line manager 90,000, depreciation of equipment 50,000, advertising 100,000, rent of the factory space 70,000, general and admin expenses $30,000. And this is why you can see that the company is making a loss of $100,000 in this line, the digital watch line. The given says that an investigation has revealed that fixed general factory overhead and fixed general admin expenses will not be affected by dropping the digital watch line. The fixed general factory overhead and general admin expenses will be assigned to other product lines when you drop this line. So this is similar to saying those are common fixed expenses or fixed cost and not a traceable fixed cost. Okay. Also, the given says that the equipment used to manufacture digital watch has no resale value or alternative use. Therefore, the depreciation expense now is irrelevant because you will not be saving any depreciation expense anymore because you will get rid of the equipment. They don't have any resale value. In light of this given, should we or should the company retain or drop the digital watch segment? Apparently, you will be losing the contribution margin of the digital watch line if you drop the line or the segment. So this is a loss for the company. You will be losing this contribution margin. On the other hand, you will be saving the salary of the manager, so it's an addition to the net income. The advertising, which is also will be an addition to the net income of the company. And finally, the rent or the factory space, which will also be saved, and therefore it's an addition to the company, to the whole company. Therefore, in total, you will be saving $260,000, and you will be losing the contribution margin, which is $300,000. And in total, thus in total, you will be missing on $40,000 if you drop the line, and thus it's a bad decision. In the third learning objective, we will learn how to make a buy or make analysis. So if you are a manufacturing company, should you manufacture some parts or should you buy it or outsource it? So buy it from a supplier or manufacture it internally. Example, SX company manufactures part 4A. So we have a part called 4A that is used in one of its products. The unit product cost of this part is direct material $9, direct labor $5, variable overhead $1, depreciation of special equipment $3 per unit, supervisor's salary $2 per unit, general factory overhead $10 per unit. the unit product cost is $30, which is the total of all those expenses or costs. The given also says the special equipment used to manufacture part 4A has no resale value. Therefore, the depreciation is irrelevant. So it shouldn't be taken into account. The total amount of general factory overhead, which is allocated on the basis of direct labor hours, would be unaffected by this decision. So in other words, the general factory overhead will be assigned to other products. It will not be eliminated, and thus it's irrelevant. The $30 unit product cost is based on 20,000 units or parts produced each year. Okay, so they are telling us that the total cost of manufacturing 20,000 units is $600,000. An outside supplier has offered to provide the 20,000 parts at the cost of $25. Should we go for this decision or not? From the first glance, you might say that it's costing me $30 internally, and I could have it, or I can have it for $25. However, this is not the case, because you need to ask yourself, what will I save out of the $30 if I outsource and go to the $25 option? So if you buy it from outside, you will pay $500,000 in total, which is the $25 multiplied by the 20,000 units. However, if you make it, how much will you save? So you will be saving the direct material cost, which is 9 multiplied by 20,000, the direct labor cost as well, the variable overhead, which is 1. Depreciation of the equipment, those $3 will remain there because there is no resale value. There is no resale value for the equipment. So this is an irrelevant cost. You shouldn't include it in the analysis. The supervisor salary, of course, will be deducted because you will get rid of the supervisor after buying it or outsourcing. And finally, the allocated general factory overhead, which is the $10, will be allocated to something else. Therefore, in total, you will be saving $340,000 if you stop manufacturing this item, and you will be paying $500,000. Therefore, obviously, you will be paying more or incurring a higher expense if you outsource, and thus you should keep on manufacturing the item 4A or part 4A. So here they're explaining to us that the depreciation of the equipment is a sunk cost, something that cannot be revived, and therefore it's irrelevant. The same applies to the allocated general factory overhead. Those $10 per unit, or in total, it's $200,000. Those will be allocated to somewhere else, to other parts. Therefore, the financial advantage of making part 4A is $160,000, which is the difference between making and buying. In the fourth learning objective, we'll prepare an analysis that shows whether a special order should be accepted. The concept of special order is as follows. Assume that you manufacture laptops and sell each laptop for $1,000. You receive a special order from a company that tells you they need 150 laptops, but they will pay for each laptop $700, not $1,000. You should make up your mind whether you should accept this special order or not. Let's see how we can do that. So I explained what is a special order. It's a one-time order, and usually the offered price, of course, will be less than the public price. When analyzing a special order, only the incremental costs and benefits are relevant. Only those that will make a difference. Okay, for example, if you have a factory and you are paying for the rent of this factory, the rent of the factory is irrelevant when making a decision whether to accept a special order or not, because you will pay either way. So this is not an incremental cost. Okay, it's a sunk cost in this case. And the same applies to the benefits. The example says, Jet Incorporation makes a single product whose normal selling price is $20 per unit. A foreign distributor offers to purchase 3,000 units for $10 per unit, half of the price. This is a one-time order that would not affect the company's regular business. The annual capacity is 10,000 units, so they can produce a maximum of 10,000 units per year. And the company is currently only producing and selling 5,000 units, so accepting this special order won't affect the main operations of the company. Should Jet Incorporation accept the offer or not? The income statement of the company says that they produce and sell 5,000 units and the selling price is $20, so $100,000 is the total revenue, less variable costs, which will give you $40,000 total variable cost per 5,000 units. So per unit, it's $8, which is the $40,000 divided by 5,000 units. And then you have manufacturing overhead and marketing costs. Whether to accept the special order or not has nothing to do with those. It only has to do with the variable cost. Therefore, what you need to keep in mind that the revenue from accepting the order, the incremental revenue, or the additional revenue, or the differential revenue, is the 3,000 units of the special order multiplied by the offered price, which is $30,000. Now you need to ask yourself, how much does manufacturing those $3,000 will cost me in addition to my existing operations? So the incremental or additional cost, it's $8 per unit, and I showed you how to compute this, the $8 in the previous slide. So the cost will be $24,000 incremental cost for manufacturing those 3,000 units. Thus, you will be making a profit of $6,000 from this special order, and therefore you should take or accept the special order. In the fifth learning objective, we will learn how to determine the most profitable use of a constrained resource. Assume that you manufacture products A and B, and you have some resource that it's constrained. It has a limited supply or a quantity. Okay? You should determine whether this constrained resource should be allocated to product A first or product B first, and whatever is left goes to the other product. And this is what we are going to learn. So, the company is said to have a constraint when a limited resource of some type restricts the company's ability to satisfy the demand. When we say the demand, we're talking about the production. The machine or process that is limiting overall output is also called bottleneck. It's the same, constraint or bottleneck, it's the same. I'll stick to the constraint. Now, the example says, a company produces two products and selected data are shown below. The product 1 and product 2, the selling price per unit is $60 for the product 1 and $50 for product 2. $36 is the variable expenses for 1 and $35 for 2. Contribution margin are given accordingly, $24 and $15. The current demand per week in terms of units is 2,000 units for product 1 and 2,200 for product 2. The processing time required on machine A1 per unit is 1 minute for product 1 and 0.5 minutes for product 2. So this machine A1 is the constraint. Okay, this is the given. So machine A1 is the constrained resource and is being used at 100% of its capacity. There is excess capacity in all other machines, so the only constraint is machine A1. Machine A1 has a capacity of 2,400 units per week. Should the company focus its efforts on producing product 1 or product 2? You need to determine, in order to answer the question, to determine which product maximizes your profit. Let's see how to do this. So, how many units of each product can be processed through machine A1 in 1 minute? Product 1, it's 1 unit, and product 2, it's 2 units, and this is because this product uses 0.5 minutes per 1 unit, and this is in the previous slides. So this is the answer, and I explained how we reached this answer. This is common sense. Now the other question says, what generates more profit for the company, using 1 unit of machine A1 to process product 1 or using 1 minute of machine A1 to process product 2? Here the answer should be per each minute of production, how much it's yielding in an additional contribution margin. And this is how you should determine your answer. The answer is that you should focus on product 2. Let me tell you why. The contribution margin per unit, or unit CM if you want, for product 1 is $24. The CM per unit, or unit CM, for product 2 is $15. We know that each minute from the constraint produces 1 unit for product 1, and each minute from the constraint or machine A1 produces 2 units of product 2. So each minute of the constrained resource is producing or yielding 2 units multiplied by the $15, which is the unit CM. Therefore, for each minute used by machine A1, I can make a CM of $30 by producing product 2 as compared to $24 when producing product 1. Therefore, I should satisfy the production of product 2 first, and whatever is left from the constraint, which is machine A1, will be allocated directly to product 1. Therefore, with 1 minute of machine A1, the company could make 1 unit of product A1 with a contribution margin of $24, or 2 units of product A2, each with a contribution margin of $15 per unit. Therefore, we are comparing a 2 multiplied by 15, which is product 2, to the $24, which is product 1. This is just an elaboration of what we've done. So $15 CM per 1 unit, and each minute of machine A1 produces 2 items of product 2. Therefore, I will get an additional CM of $30 for each minute invested in product 2 as compared to $24 for each minute invested in product 1. Therefore, you should satisfy the demand of product 2 first and then allocate the rest of the constraint to product 1. So let's see how the plan would work. Weekly demand of product 2 is 2,200 units multiplied by 0.5 minute from the constraint or machine A1. This means that I will need 1,100 minutes to satisfy fully the demand of product 2. Remember that the machine operates, the maximum operation of the machine is 2,400 minutes. So we are left with 1,300 minutes, which should go to product 1. So as you can see, the 1,300 minutes now are allocated to product 1, and in this way you will maximize your profit by completely satisfying the demand of product 2, and the rest should be allocated to product 1. So satisfying the demand of product 2 will get us a total contribution margin of $33,000 and $31,200 from allocating the rest of the constraint to product 1. And therefore, in total, the company will have a contribution margin of $64,200, which is the maximum possible combination. In the sixth learning objective, we will determine the value of obtaining more of a constrained resource. So, for example, in the previous question, we were short on a few number of minutes to satisfy the rest of the demand of product 2. What is the maximum amount I'm willing to pay to satisfy the rest of the demand? It should be the contribution margin per minute, which is $24. Let's see. So the additional machine time would be used to make more units of product 1, which had a contribution margin per unit of $24. The company should be willing to pay up to $24 per minute. This amount equals to the contribution margin per minute of machine time that would be earned by producing more units of product 1. Now, example. A company makes reproduction colonial furniture from select hardwoods. So they manufacture chairs and tables. The selling price per chair is $80 and the selling price of a table is $400. Variable cost per unit is $30 per a table and $200 per a chair and $200 per a table. Therefore, you can tell easily that the unit CM per a chair is $50 and it's $200 per a table. Board feet per unit, it takes us 2 feet of wood to manufacture a chair and 10 feet of wood to manufacture a table. The monthly demand for chairs is 600 chairs and 100 tables. Now, the company's supplier of hardwood will only be able to supply 2,000 board feet this month. Is this enough hardwood to satisfy the demand? So you need to compute the total need of wood. So we have 600 chairs multiplied by 2 feet of wood plus the 100 tables multiplied by 10 feet of wood. So in total, you will need 2,200 feet of wood, and you can only get 2,000 board feet of wood. And therefore, you need to prioritize whether to satisfy in full the demand of chairs or the demand of tables so that you maximize your profit. So this is the answer of the question, and the answer is no. The available or supplied amount of board feet does not satisfy my demand in full. I will be short on 200 board feet. Now the given says the same given stands, so we are able to supply or to get 2,000 board feet of this month. What plan should maximize your profit? Should you satisfy in full the demand of chairs or the demands of tables? Of course, this is unattainable. You cannot do this because this exceeds the available resource. So to tell which product should be prioritized, you need first to compute the unit CM. And the unit CM for chairs, as I told you or showed you, is $50, and for tables, it's $200. Now, the CM per 1 foot of wood for the chair and for the table. Okay? So to do this for the chair, it's equal to the $50 divided by 2. And this is the 2 feet of wood. So $25 per foot. So each foot of wood invested in chairs is yielding $25 CM. As for the table, it's the $200, which is the CM, divided by 10. And this is the 10. It takes me 10 feet of wood to manufacture a table. And this is yielding to $20 per foot of wood. Therefore, chairs should be prioritized, and whatever is left from wood will be allocated to the tables. Thus, the optimal combination is B. So this is what I showed you, that the CM per board foot for the chairs, it's 25 as compared to 20 for the tables, and thus we should prioritize the manufacturing of chairs. Then they asked us, as before, the company has a constraint of wood. Assume the company follows the plan we have proposed, which is prioritizing chairs. Up to how much should the company be willing to pay above the usual price to obtain more hardwood? The maximum should be is the CM of tables per 1 foot, right? Which was $20. Exactly. So it's the CM or unit CM divided by feet or board feet or foot of wood. It's the same. Now, in our last learning objective, we will prepare an analysis that shows whether joint products should be sold at split of points or processed further. Joint products, let me give you an example. If you cut a tree, cutting the tree gives you 2 products, wood and dust, the dust of the wood. You can sell those 2 products at this point, which is called a split off point. And those 2 products together are called joint products. Joint products. Or you can process them further. You can manufacture from the dust cardboards, for example. And from the wood, you can manufacture, let's say, I don't know, tables. So whether to sell them at the split off point or go further with the manufacturing process to sell them as tables and cardboards is a decision that you need to make. And the decision rule is which option to sell on split off or go further with the process, with the manufacturing process. What determines this decision is which option maximizes your profit. So I explained what we mean by joint products and explained what we mean by split off point. A decision to whether a joint product should be sold at a split off point or processed further is known as sell or process further decision. So either you sell at split off or you process further. Example, a joint input that gives you a common production process. The split off point will give you oil, gasoline, and chemicals. So for example, in the petroleum refining industry, a large number of products are extracted from crude oil, including gasoline, jet fuel, home heating oil, lubricants, asphalt, and various organic chemicals. So should you sell them at this stage or go further with the production process to get asphalt, lubricants, and organic chemicals? So processing oil further will give you some other final sale. gasoline will go directly to the final sale, and chemicals can be separated separately to sell various products. It is profitable to continue processing a joint product after the split-off point as long as, so this is the rule, as long as the incremental revenue of such a decision exceeds the incremental cost. Okay, so the additional revenue going beyond the split-off point should exceed the incremental cost of going beyond this point for this product. An example says a company cuts logs from which unfinished lumber, so we're talking about wood here, and sawdust are the immediate joint products. So when you cut trees or logs of trees, you can get unfinished lumber or unfinished boards of wood and sawdust, which are the joint products in this case. Unfinished lumber is sold as is, or the alternative, processed further into finished lumber. The sawdust can also be sold as is to gardening wholesalers or processed further into presto logs. So further manufacturing of unfinished goods will yield finished lumber, and manufacturing sawdust further will yield presto logs. The sale value at the split-off point for lumber is $140.40 for sawdust. The sales after further processing is $270 for lumber and $50 for sawdust. So the incremental here revenue is $130, and here the incremental revenue is $10. The allocated joint product cost is $176, and further processing is $50. As for the sawdust, it's $24 at the split-off point, and the incremental of further cost processing is $20. Obviously here the 20 exceeds this is the additional cost, exceeds the additional revenue. However, for the lumber, the additional cost is less than the additional revenue, and I would go with further processing for lumber, but I will simply sell sawdust at the split-off point. So as you can see, further processing of lumber will yield an additional at $80 of profit, which is the 130 incremental revenue minus the 50 incremental cost, which is the 80. So this is something good. As for the sawdust, incremental revenue is 10 and the incremental cost is 20. So it's a minus $10 if you go further. So stop at split-off point and sell sawdust as is. So the lumber should be processed further, and the sawdust should be sold at the split-off point. This is the end of the chapter. Thank you for your attention.